The reality is that the interest rate doesn't matter. You don't build wealth based on an interest rate, number one. And number two, you don't even know the interest rate you have on loans that you currently have. The reason why the interest rate matters so much to people, and I say it doesn't matter, of course it matters. And of course, I'm going to give my client the best rate I possibly can, but you don't get wealthy off of an interest rate. You get wealthy based on using money properly.
So today we have Annika Lynn. She's a senior loan officer at Movement Mortgage based right here in Indian Land, South Carolina. She's backed by her team's extensive resources. She has specialized in simplifying the mortgage process and guiding clients through financial options for purchasing, selling, refinancing, and even building homes. Annika, thank you so much. I greatly appreciate you being here, and make yourself at home.
Thank you. And I'm so sorry, Dee. My first name is pronounced Annika.
Annika, oh, I'm so sorry. Oh my goodness.
I'm so sorry I didn't catch it earlier because we've been talking and I'm so sorry. It's one of those names.
Well, you know, it's funny. I was born Deana Annette, and Mom never has called me Deana. My family has never called me Deana. My name is Deanne. But when you have a name that's spelled Deana, you become Deanna.
Oh, yes.
Especially down here. And that's why I go by D.
That's great. Easier. That's great.
Well, Annika, how did you find your way into the mortgage industry?
It was really a funny way to get into it. So I had been a stay-at-home mom, little part-time job. I homeschooled my amazing 6 children. And then in 2014, I just had this 3-week period where my entire life got flicked into the air like, a deck of cards. I found out in February that I had 2 kinds of cancer. A week later, my husband, he told me he got laid off, but we lost our insurance that day. And so years later, like 2 years ago, I went, wait a minute, he got fired. I still don't know what in the world happened. And then about 2 weeks later, he was gone. And the marriage had been falling apart prior to that, but suddenly there I was with 6 kids, no income, no insurance, facing a double mastectomy. It was just a crazy year. And I had to figure things out. I had to figure out a way to make ends meet. I had graduated. I have a master's degree, but my undergraduate was very useful. It was in German with minors in French communications and music. And I had a master's degree in the arts of teaching, but I didn't want to teach anymore. And one weekend, my dear friend, May Dodson, was showing me yet another video of Movement Mortgage changing the world. And I thought, you know what? I love math and I love people. I'll be a loan officer. I knew nothing. I knew nothing. I didn't even have a credit card. I knew nothing about debt, but I do love people and I'm really good with math and money. And I was being chased by a dragon. So either I figured it out or my kids didn't make it. And so that's how I started in the mortgage industry. And by God's grace, had a couple of amazing mentors for a full year and taught me everything I know. And after that, I went out on my own. And within a year or two, I was listed as one of the top lenders in the country. And I've been there ever since. So it's a true honor and privilege to get to do what I do. And I'm very thankful for that time in my life because God, I believe God always works things together for the good of those who love him and who are called according to his purpose, just to quote a little scripture. And he, sure enough, a really horrific time, something amazing came out of it. So, yeah. So that's how I became a loan officer.
That is an amazing story. It's kind of like mine, but it's, it's how God kind of, kicks you in the rear end into where you're supposed to be.
Yeah.
What is the why that drives your passion for helping families today?
Such a great question. In my life, from getting out of college, I've always worked with kids, young people. I worked with juvenile delinquents in New York, very dangerous job, changed my life. I've taught ever since then. I taught pre-calculus. I still love my beautiful students. And I just love to help people. And I believe very strongly that you cannot build wealth without owning real estate. And I think that our industry, my side of the industry in particular, is so shrouded with smoke and mirrors. And the most important thing a client can do is find a lender that they can trust implicitly, and to find a real estate agent that they can trust implicitly. Like you say, sometimes you're building a team when you buy a house. You need somebody that's going to tell you the truth, because there is no truth on the internet, for instance. It's all smoke and mirrors, and everybody's playing the game of money, as I call it. And the game of money is, I want your money. And so anytime you read something online that has to do with money, if you read it through the lens of, they're playing the game of money, they want my money, it helps you to correctly interpret it, but it's still hard. You cannot figure this out on your own. The lending side of things, that is, even money. And one of the biggest things I learned through my huge crisis in 2014, where at the time I was very isolated. I was home with 6 kids. I was super busy trying to be a great teacher. I really learned how much I need people, and how much I need a team, that we were not created to be lone rangers. We need each other. And so I'm really inspired by, and first of all, the privilege to speak into people's financial lives. It's an honor. It's a privilege to get to do that. But more than that, the privilege of helping them grow, because everybody wants to do well with their money. Sometimes they want to be a good steward. They want to sleep well at night. Some people want to, everybody wants a strong family, a secure family, and to build wealth, And so when you have a team that understands the process, that's how you win.
It's funny, you said there's so much smoke and mirrors. I always think back to that small little meme that it says, never believe anything you read on the internet, said Abraham Lincoln.
That's great.
Yes,
it's so
yeah,
true.
that's about right.
Right, exactly. And one of the things that it's so upsetting to me to see commercials that really are geared toward taking advantage of the people that are least informed. And one of the most recent ones is, hey, you can get a home equity line of credit without getting a loan. There's no payment. And if you don't understand it, what you're doing is you're giving away equity in your home. You're giving away your home ownership. And you watch these commercials that are specifically geared toward people that are undereducated or don't have a team that they can trust. And it's scary, so.
Financial literacy is one of those things that is never taught in school. Yeah. And if you don't have somebody who can teach you, you have kids, I have kids, and we every single day try to teach our sons who, are in their 20s. And finances it's the number one reason that people get divorced. It's the scariest thing that people think about.
Yes.
Because people mostly are chasing money, and they think it's, it is this thing that they never can have. And Lord forbid, the social media, it makes everybody think that, everybody else is doing better than I am. They don't have to go to work, and the number one things that, kids used to want to be singers and basketball players and football players because they made so much money. Now all these kids talk about is like, I want to be an influencer.
Right. Here's the truth of the matter. I used to say to people, if you took all the money in the United States and you spread it evenly among every single person in the country, give it 2 years, it'd be right back where it started. Because the reality is those NBA players or football players, they don't stay rich. They lose their money if you don't know how to play the game of money. You have to know the rules of the game. And, and so one of the things I do in the course of working with my clients, I tell them, I don't really care about your loan. That's just one tiny puzzle piece in your whole financial picture. I care about your whole financial picture. And I'm going to look at your whole financial picture. I call it the 4 legs of the table. I look at each leg and I advise them on income, debt, emergency fund, and investments, meaning your retirement account and real estate. That should be about 50-50 there. And I look at that whole picture to try to give them guidance on how to properly handle the money that they have so that it grows, so.
And we, when our son was getting ready to buy his house, it wasn't just, he had saved up, him and his girl had saved up just, a good lump sum of money.
Wow.
And we were talking about, okay, well, if you put every single dime into your loan, this is what your payment's going to be.
Right.
But if you save some of it back and
Yes.
actually make one extra payment, you can actually shorten your loan. But
Right.
we know what happens. Life happens. The washing
Yes.
machine breaks. The refrigerator
Yes.
breaks.
Yeah.
You have to replace something. Your car has to go into the shop. And not having that safety net
Yep.
that you have, that you're thinking, oh God, I'm not going to be able to make my house
Yeah.
payment, or,
Right.
we're going to be in so much trouble. And so we try to look at people's entire
Absolutely.
financial, literacy, again, their entire finances, so they can make the best decision and not
100%.
be broke every single, or paycheck to paycheck.
And I would tell you that the biggest missing link for most people, other than, debt's a big issue. I talk about debt with every one of my clients. But most people, I always used to tell my kids, the problem is never the problem. When my son missed the school bus, the problem isn't that he didn't get up on time. The problem isn't even that he went to bed too late. The problem is probably that when he got home from school, he didn't do his homework and played video games instead, so that he then had to do the homework late at night, so that he went to bed late. And the truth of the matter, that applies to money as well. The problem isn't that you're not making enough money or that you have debt, although that's, I'm sure, a part of the problem. The problem really is if you don't have an emergency fund. You have to have an emergency fund. So just teaching my clients the numbers of that. What should your emergency fund look like? How can we make it simple? How can we make it automatic? So working through some of those things so that, yeah, of course we want them to buy a home. You cannot build wealth without owning real estate. But how do we do that in the wisest way so that you're building wealth holistically, not just, like with, buckshot or something? We want to have a plan.
Well, you also talk about, the emergency fund, the problem isn't a problem. You have to put brakes on your car. Okay, well,
Right.
That's not a problem unless you
Right.
don't have the knowledge or don't have the means to be able to put brakes on
Correct.
your car.
Yeah.
So we can always solve a problem. We just have to figure out how.
Right.
What's one thing that, if you could pull the curtain back on the lending world for a moment,
Sure.
What's the one thing you wish every listener knew before they even started looking for a home online?
That's a great question. Well, I think you cannot start too early with a trusted loan officer. That's probably it, and people call me, oh, don't pull my credit. Well, you need me to pull your credit. And sometimes I said just this very morning, I said to a client, listen, when you go to the mall, please don't walk into every store and take your clothes off. But when you go to the doctor, you got to take your clothes off. So in other words, don't get a Kohl's credit card and a Best Buy credit. They try to lure you in. We're going to give you 20%. Well, nobody gives away money. They're playing the game of money. They know they're going to get your money if you open that credit card. But when you're looking to buy a house, that's when you need me to pull your credit, because then we can, especially if you're not ready to jump right away, I'm going to look at your credit. I'm going to go behind the scenes and say, hey, if you did X, Y, and Z, we could increase that credit score by, 20 points or sometimes 100 points if we've got time. So start early to find your team so that when you're ready, because a great loan officer is going to do much more than just help you get a loan. They're going to help you get set up for long-term financial success.
Correct. So many buyers, again, fear that credit pull. How do you explain why having a precise budget is critical before you ever start house hunting?
Great question. So two things. One, let's discuss why there's a little tiny dip in your credit score when you pull it. So Dee, obviously you and I are very best friends since we finally set eyes on each other and are talking to each other. So this weekend, we have already decided, we know this, we are going to go buy matching cars because we love each other. What could be better? So we're going to go to this car dealership. Oh my gosh, we found the perfect car. We're sitting down, we're filling out the paperwork. They've pulled our credit so that we can get loans. Not that we would get a loan for a car, but anyway, this is a story. So just before we sign on the dotted line, we look at each other and we go, let's go to one more place. So we go to the next place. The exact same thing happens. And we do this 7 times. On Monday morning, our credits have been pulled by all these different places. There's a certain amount of uncertainty in the credit world. Did they just go out and buy 7 cars? Why? because new credit doesn't hit your credit report for 30, 60 days. It takes time for a new loan to come out there. So to accommodate the potentiality that we've bought 7 cars, those credit scores drop your score just a tiny bit. As soon as that time period is gone and it's clear that we haven't bought 7 cars, you get those points back. Okay. So pulling your credit is super necessary because, again, I can help increase your score sometimes by 20, 50, 100 points. But even more than that, we can figure out, are you all set? We can take a look at the liabilities that you have. Hey, what is, if I could wave a magic wand, I sometimes say, I would like to see you do this. Usually it's pay off debt, right? But I can see really what's going on. That's how we figure out what you not can afford, but what you want to be able to afford in the context of your family and your goals financially, the time of life that you're in, et cetera. Number 2, related to this, a 2-part answer to your one part question is, when you have been hanging around with a star quarterback, it's really hard to start dating the ball boy. So if you're looking at $700,000 houses, but you're really only comfortable with the payment that goes with a $300,000 house, it's going to be really hard to fall in love with your house or to find a house that meets your needs because you've expanded, you've been looking at something way beyond your budget. Does that make sense? Yeah. So those are the 2 reasons. You've got to get your credit pulled, and the credit report lasts for 120 days. So I'm not going to re-pull it again until that time has passed and you've regained those points again.
Yeah.
And hopefully are better.
We always talk about, I can show you any home, but if I walk you into the biggest house that just hit the market in Fort Mill and it's
right.
$4.5 million, you're not going to want the $450,000. Or how many times have you, I'll show my age. We watched MTV Cribs back in the day, and you got to see how these people lived, or
right.
I'll really show my age, Lifestyles of the Rich and Famous.
Yes.
What was his name? Robin Creech.
Leach.
Leach,
Teach.
something like that. You have to watch how these people lived, and it's like, I wake up every day and I have to feed my dogs. I don't have somebody to feed my dogs for me.
Right.
I have to know how I can live, and that's huge,
And the truth of the matter is that sometimes I used to tell my kids, the person driving by you, this is sort of a generalization, but oftentimes the person driving by you in the BMW with the perfectly coiffed hair and the Fendi handbag, they're neck deep in debt. People that are really wealthy often don't look it. They drive old Hondas and they shop at Goodwill, whatever, and so wealth is not about, the ostentatious, let me show you how rich I am. It's about living a life a certain way. And you can be very wealthy and not have a lot of money, and you can be very wealthy simply by not having debt, So yeah, interesting conversation.
It's what most people don't think about. I mean, you see all of these things. You can't compare yourself to someone else. It's, am I better than I was yesterday?
100%. And understanding that often what you see is not the truth. The Facebook family is probably a little different in reality behind the scenes, So, yeah.
In Charlotte, we're a very competitive market.
Very much so.
How does a rock solid pre-approval from your team give my buyers the ultimate negotiating leverage?
Right. So a couple of things. Number 1, if I'm not 100% certain on your client, they don't get a pre-approval letter. To the extent that I'll underwrite a file, if I'm not 100% certain. I, as a lender, I look at everything. I'm going to try to underwrite the loan myself. My goal is always to answer every single question I think my underwriters are going to have, even before they ask them. That's why my files sail through underwriting, usually. As a principal, if something goes wrong on a file, I don't care who makes the mistake. I'm the one who makes the phone call. And for that reason, I don't like making that phone call. I'm really cautious and careful. Number 2, I'm local. I've got a great reputation, and I'm going to call that list agent for you and go, hey, Dee, I want you to know you've got that offer that came in. This is a great client. They're beautifully pre-approved. I've reviewed their assets and their income. They're good to go. But even more importantly than that, my job is to protect my client. What is worse than a client that goes under contract? Now they've got $2 or $3 or $5,000 in due diligence that is gone if they break that contract. I don't want to have to go back to them and say, hey, you're actually not approved. Thank goodness that doesn't happen often at all. Sometimes there's things I don't know. If you don't tell me the truth about something, it's going to come out. There is no lying in this industry, but that's the value of it. It's not, yes, it's going to help you get that offer accepted. And I think being a local lender, as opposed to the big box lenders, they will throw out a pre-approval letter to just about anybody. They don't care. It really matters that you get somebody who's really going to be looking at all of those numbers. And local is great because they're afraid of running into you at the grocery store, if the lender, if they're not doing their job right. So, yeah.
So how do you keep buyers focused on the long-term wealth when the media is constantly pushing this fear about shifting interest rates?
Yeah. So interest rates is always an interesting question, and they don't matter at all. And let me ask you this question because I'm curious. How many homes have you owned?
Me personally, I have owned 3.
Perfect. What was the interest rate on all of them?
Technically, I've owned 4 because I did have a loan on. We had a home at the beach, which was a way for us to make passive income. So I had I had a rental property.
All right. So what were the interest rates on all 4 of those?
Oh yeah, this is where we start talking. My very first home was at 9.25%.
Wow.
On $108,000. That was my very first home.
Wow. What was your second?
So then we moved to back to the Charlotte area, and my second home we were at, I think was that we actually had several loans on that. I remember one time when my husband and I at the time we were looking at this house. And he was like, we have to have this loan. We have to have it. And I looked at him and I went, it's at 11%.
Wow.
And it was an ARM. I said, it could go up to 15%. Are you aware of that? And I was the one who paid all of our bills. So he was like, we just have to get this. And I'm like, dude, do you understand where this will put us? If it goes to that 15%, we can't afford that.
Yeah.
And that was one of the ones that was really eye-opening, that he wasn't looking at how do you make your payment later on. And I was like, I knew we were going to get into a really bad place. The other homes that we have had, like my current home is at 3% because I was thankful and was able to get a loan at that place.
Yeah.
But that's unusual for a lot of people.
Right.
And
that's never going to come back.
Yeah. And
you're actually surprising me because I've owned maybe 4 or 5 homes. I have no idea what the interest rate is on them. I don't know.
The rental income that I had with my mom, I have no idea what that that percentage rate was.
And so my point is, and then I ask my clients sometimes, what's your interest rate on your credit cards? They don't know. What's your interest rate on your student loans? They don't know. The reality is that the interest rate doesn't matter. You don't build wealth based on an interest rate, number one. And number two, you don't even know the interest rate you have on loans that you currently have. The reason why the interest rate matters so much to people, and I say it doesn't matter, of course it matters. And of course, I'm going to give my client the best rate I possibly can. But you don't get wealthy off of an interest rate. You get wealthy based on using money properly. And interest rates are what interest rates are. They're materially the same from lender to lender. Why? Because all loans are sold to investors who then sell it to Wall Street, where they end up in yours and my 401ks. So rates are what they are. People worry about rates so much because it's the only question they know to ask, which circles us back to find a lender that you trust, find somebody local, find somebody who's going to answer your questions, who's going to care more about your whole financial picture than anything else. The interest rate will take care of itself. And I'm going to give you 2 examples of that. Number one, my clients today that maybe have a 6.375 interest rate. First of all, that's a half point better than last year. But again, who cares? And we'll discuss that more in a second. But when rates come down, what am I going to do? I'm going to refinance them out of it. And so when rates are high, there's a really hidden and wonderful benefit. And that is for every 1 percentage point rates drop, 5 million borrowers step aside. They leave the market. So high interest rates represent a really wonderful opportunity for you to get into a home for a lower purchase price. So the higher the interest rates are, the more under control appreciation is, the more on sale you can get a home. The interest rate is temporary. The purchase price on your home is permanent.
We talk about this all the time with folks about you're sitting on the fence and you're waiting for interest rates to drop. And we talk to our clients about this. It's like, my clients say they want to wait for interest rates to drop, but there's will the interest rate drop outpace the price going
home
up?
Appreciation.
And that typically doesn't happen.
Correct. You're going to, you'll pay more with a lower interest rate. You will pay more next year with a lower interest rate because your purchase price will be higher. It's exactly the wrong way to look at it. And frankly, no one wakes up in the morning and says, I'm going to buy a house today because interest rates are low. That's not why people buy houses. You buy houses because you need a house, because you're sick of throwing away money on rent, and because you want to build wealth. And it's kind of like the stock market. I don't look at the stock market and invest when, the prices are great. I mean, if I have extra money and, there's a drop in the market, sure, I'll throw some extra money at it. But I invest systematically and routinely every single paycheck. Money goes into my 401k. And I've done it for years. That's how you build wealth. It's not sexy. You can't game the system. You just get in where you can fit in. And then, like I said, interest rates, as they drop, we refinance.
When we're talking about that, because I've told this story a couple of times when I've had a client who was in her 20s and she was able to buy a bigger house than what she thought because it was $400,000 and her interest rate was low. Her interest rate was at 3%. She called me the other day because she's getting ready to have another baby. And she said, when are interest rates going to be 3% again? And she's a young lady, just like my sons are. And I told her, I said, all right, let's look at it. All right. When interest rates were 3%, the world was on fire. Most everybody around here who worked in the banking industry lost their job. Nobody's home was worth what they said it was. And so the government said they had to drop interest rates down for people to be able to purchase homes again. The last time that happened before that, so there was an economic crisis for us to get to that. The last time that happened was World War II.
Right.
That was 60 years ago, 80 years ago. If you think about 1944 was 80 years ago. That is astronomical, especially for us, because we turn around and go, okay, well, the 1970s were just yesterday, or it was 1990. No, that was 30 years ago. So
exactly.
If it's 80 years between these catastrophes that happen, the next time it's going to be 3%. Okay, so let's see, 2100, because it's 2025 right now, 2026.
Right, exactly.
If it's 80 years, then we're looking at 2100. Or,
exactly.
I'm
exactly.
like, really? You're not going to be alive at that point. So when you're waiting for interest rates, there's a mathematical reality that goes along with waiting for an interest rate. You can have any interest rate from what I understand, but it may be astronomical to get that interest rate, right?
Correct.
So what are the costs that go along? What are the hidden costs of waiting for that interest rate? Well,
again, you lose out on appreciation 100%. Meanwhile, rent is going up. You especially if you're a renter, if you can buy a house, you should, to capitalize on the appreciation of the home value, and because you're building equity, you're building wealth through that bucket. So the cost of waiting is dramatic because really a home ownership is simply another investment bucket. And again, people don't buy houses because of interest rates. You're focusing on the wrong thing. We're here for long-term wealth building. Your interest rate is temporary. So rates are high today, whatever. Give me a year, give me 2 years, I'll refinance you so that it makes sense, so that you save yourself some money. It's the wrong focus.
As long as you can afford it.
Absolutely. Yes, absolutely. Yes. And that again comes with having that great loan officer that's going to look at your whole picture and make sure that the way you're using money is, because it all has to work together. There's a synergy to it between your income. How is your income? Can we increase that in any way? What's your debt situation? How much are you spending on debt? Can we fix that? Let's fix that, because that's a big problem. You want to get poor fast? Have debt, especially credit card debt. Do you have that fully funded emergency fund? And then the wonderful thing is that once you have no debt in an emergency fund, you can really sock away at paying off your mortgage. I paid off my last mortgage in a couple of years, literally. Bought the house, paid it off within a couple of years. Zero mortgage on my primary residence. I love it. I just bought a beach house. I'll pay that off in a couple of years too. Why? Because I have no debt. So I can be very nimble. Sometimes I tell people, I talked to a client the other day with a bunch of credit card debt, and I said, it's kind of like we're both walking across the stream. There's a current. It feels a little shaky, but I'm going to be fine because I have nothing, encumbering me. You're walking next to me, but you've got 12 vines wrapped around your legs. I'm really worried that you're going to drown. So you should be much more worried about debt, credit card debt. You should be much more concerned with the interest rate that you're paying on those credit cards. A lot of times I'll do the math for clients. They've got X number of $1,000 on a credit card. They've got a $325 payment. I'll do the math real quick and go, hey, of your $325 payment, 300 of it is going to interest. That is something much more concerning than what interest rates are. They're the same across the board, and they're balanced out by inflation as well. So that dollar today, let's say your mortgage payment is $2,000. As inflation causes the value of the dollar to decrease, your payment essentially is decreasing, even as your income is increasing. Now, is it a concern for our first-time home buyers? Of course, because the affordability is a true issue. But that's where we can, have some little tricks up our sleeve, meaning do a temporary rate buy down, something like that, where your interest rate is dropped by a percentage point or even two for the first couple of years for the life of the loan. That can really help clients to stem that distance between today's rates and tomorrow's hopefully lower rates, to give them time to be making more money, because people tend to get raises. So there are ways of helping a home be more affordable while protecting the client's, long-term financial goals.
One of the other things that people look at is you finance both new builds and resales. And we talk about that, an existing home or buying new construction.
Sure.
What's the difference in the loan process if somebody is trying to build a custom dream home?
So what you get when you build that custom home is you get a second set of eyes watching over the process, a second set of very experienced eyes that will make sure that your contract, that your bid is in line with what it should be. That'll vet your general contractor. Your GC gets vetted like he's another borrower. Does he have experience? How's his credit score? How's his financial fiduciary, situation? Does he have all of his ducks in a row? And it helps you not to get hung out to the cleaners. I have a great friend, love him dearly. He's stopping by this afternoon, driving into town, and they just built a house. And they are really having trouble with the builder. Now, they did it by cash, good for them. But the benefit of having a lender oversee it is they want to make sure this house is properly built because they have a huge vested interest in it. So you pay for that a little bit with a slightly higher interest rate, but you get something for it. A few extra fees, there's some management fees and stuff like that, but entirely doable and can be a great process. For that first time home buyer, for somebody who's not pretty solid financially, I often sort of try to guide them toward, hey, is there something out there that'll meet your needs? Because it can be very expensive, because building materials are so expensive nowadays that it's sometimes the cost, the opportunity cost is greater than it needs to be when you're buying a home. And of course, you and I both know that you're never buying your dream home as your first home. We're working our way up to that dream home. So did that answer the question?
Yeah, and some
Okay.
of the things that we talk about is like even when you're looking at new construction, or if because even if you're building your custom home, it is never going to be everything you want
No,
ever. And
never.
that is one misconception, is because
Yeah.
people think, well, I'll just go over here to this builder and
Yeah.
I won't take an agent with me, because this builder has to be honest with me when they're building my home. And if I don't take a realtor with me, then I can save that money on commissions. I'm like, no, ask them straight up front when you're talking to them, will you take the realtor fee off the price? The builder is building their own comparables. So if they take money off of your home, they're going to have to take money off the next home. So they always have realtor fees built in, unless you're dealing with super custom. And at that point, maybe, but at that point, you're talking usually 7 figures to be able to.
I just talked to a client dear client of mine. In fact, his realtor is in your office, and I adore her. And he said, I'm thinking about this new build. I'm just going to use the agent at the builder's office. I said, no, because that realtor is working for the builder. That realtor is not working for you. You need somebody to be your advocate in this process. And that's where a fantastic realtor is worth every penny that you give them. And that's where certainly your experience, you've been in the industry for nearly 2 decades and you've got a fantastic reputation. You're the kind of realtor people need to be working with. So yeah.
When you're dealing with new construction, there's a lot of misconceptions that come with that. And there's a lot of things that, in our opinion, are not fair, because the states allow for a builder to say, hey, if you use our lender, we'll give you all of this money. And regular lenders can't compete with, I just had one client, we got $40,000 in money off of their house that they could put in a lot of different places.
Sure,
but
absolutely.
if you go to a lender that maybe like and trust, they're like, I don't have that. There's no pocket of money that I have that is anywhere close to that. But how is that supposed to be fair to a buyer? Because the builder is basically playing the shell game, because they have their own lending source.
And, builders are in business to stay in business. And so they like to control every aspect of the process. And some do it right, some don't. I'm doing a loan in Pennsylvania for this sweet client, and the builder was giving them money, and it really wasn't very much. And then they turned around and gave them a horrendous interest rate. There is no free money. No one gives away money. And so even that lender that says, hey, if you use me, I'm going to give you this money, it's coming from somewhere, usually the rate, and so sometimes builders will build it into their purchase price or to their sale price of the home. You're paying for it somehow, some way. But a lot of times they'll even lead with a certain foot. I'm talking to another client, and some lender came to him and gave him this crazy low interest rate. I said, well, get it in writing. Well, he got it in writing. Well, suddenly the interest rate jumped up. Now there's extra fees. And so sometimes I had a client working with a particular builder, and they said, can you just come take a look at this? Well, of course. So they sent me the loan estimate, and you as a client, you don't know that maybe you're getting eviscerated fee wise. And sure enough, there was a $20,000 fee that completely ate up the credit they were being given, and they had a horrendous interest rate. So a lot of times what seems like a wonderful bonus or a benefit or a shortcut, it's really not. And so having that trust relationship is super important.
And being able to see it and look at it, compare apples to apples, because it does matter.
Yeah, yeah.
So if clients are torn between renovating an older home, building from scratch, what are some financing factors that they should weigh in?
Sure. How much equity do they have in the home? Are they able to pay for the financing, or do they need me to do it? So a 401k loan, or a 401k, sorry, a renovation loan.
203K.
Thank you.
Loan.
Oh my word, 203k. A 203k loan can be a really wonderful opportunity, because sometimes people cannot see farther than ugly. But the first call is to you, Dee, to go, is this an area that is going to increase in value? If I do this to the home, am I going to outpace the value of the homes around me. You don't want to have the nicest house in a neighborhood, And so oftentimes I'll say, hey, call D and see if you make these renovations, is the value of the home going to increase apace, or are the homes around it? Because appraisers use comparables when they determine values to the home that take into account the benefit, the improvements you've made, but they also take into account the rest of the neighborhood. So does all of this make sense? Or could you find what you really want already done in a place that's going to carry the value?
Exactly. Because the last thing you want to do is put all this money into a house and then it's the nicest house in the entire neighborhood and you're never going to get the money back out of it.
Yeah.
Or you'd have to own it forever and then your kids have to own it just for it to
right, exactly. Yeah. Or you end up losing money on it. Now, if you're never going to move, there are people like that. Maybe you make improvements because your house is yours at the end of the day, but it's this two part. It's 50% your house, but it's also 50% a financial investment, so you have to look at it both ways. It's neither one nor the other. It's both.
Well, I mean, there's nothing wrong with having a Wolf stove, especially if you love to cook. But your next buyer may not see the value of a Wolf stove. That may 100%. Be something that you change out later, but you do it for you. And it's okay to do things for you.
Yes. Yeah.
Now, when we started 2026 and everybody was talking about where are we planning on seeing us at the end of this year? And I know that has shifted completely. Exactly. Because nobody saw a war with Iran coming. So that
Which is kind of why I never even have the conversation. Yeah. Because you cannot predict it. You just cannot know. People think the rates are going to continue to fall. Probably. I think they probably will. But do I know? Absolutely not. Because you just have no idea. Interest rates are impacted by so many things, by global unrest. Certainly, oil prices are having a dramatic effect. It's not really the war as much as it is oil prices. But then also when rates are high, investors bake into their interest rates a little bit of extra because they know people are going to refinance. So when a servicer buys a home, it costs them about 1%. They make about 30 basis points a year. So it takes an investor or a servicer 3 years to come ahead. When investors know that people are going to refinance in a year or two, they have to accommodate that potential risk of loss by increasing interest rates. So it kind of circles all back to who cares? It doesn't matter. Rates are where they are. If you got higher rates, you probably have a lower purchase price.
Yeah. So when we're trying to see the shifts that are coming, how do we determine if a client should actually refinance or just versus
Great question.
Chasing after the lower number?
Right. So refinancing is a math problem. So a refinance costs money. Let's say it costs about $3,000. So I look at it in a couple of ways. One, I look at it and say, how much are you saving a month? If you're saving $300 a month, you're going to recoup the cost of that refinance in 10 months. Are you going to stay in the house for 10 months? And do we think you're going to stay in this loan for 10 months? So if I can recoup the cost of a refinance I think that some of the government loans want to see it recouped in 3 years. I like to see it in, 18 months or less. And then are you going to stay in this home? If somebody's in their 60s, right? They're going to, probably not move again and again. You're 20 years old and you're pregnant with triplets. Well, let's look at that. So it's a conversation that includes their whole financial picture. Sometimes it's a strategy. Okay, do we refinance and maybe do a cash out refinance because you're carrying $100,000 in credit card debt and we're trying to right this ship? On one hand, I don't like doing that because really what am I doing? I'm taking credit card debt and I'm financing it into a 30-year loan. Okay, so I don't love that. But if we can do it as part of our strategy, okay, now that your credit card is paid off and we just saved you $1,500 in money going out to credit card payments, all right, let's now make your mortgage payment plus an extra $1,000 a month. And then we can cut down the life of the loan by X number of years. That's a math problem too. So if you can do a refinance, if it makes sense financially, the cost of the refinance is recouped quickly as part of a whole strategy to reduce debt, but it has to go hand in hand with a plan to change a lifestyle, change habits. There are times I say, first of all, I'm not refinancing you. It doesn't make sense financially. Or I'm not going to refinance you because then the next time you call me, it's going to be for a bankruptcy unless you decide to change your ways. And that's going to mean closing off credit cards and, doing some things, So I've been able to help some clients with that as well. Super exciting. And then, the higher your loan amount, the faster it makes sense to refinance. Sometimes people say, oh, I need to save a whole percentage point. Well, not if your loan amount is $800,000. It really, the math is what's the amount of interest savings per month divided into the cost of the refinance.
So there's another thing, since we're talking about cash out refinances, there's a lot of things that people have been talking about buying that second investment property. Because you said you just bought one yourself.
Oh,
that
yeah.
People what's the safest way for a homeowner to use a cash out refi to potentially buy a second property without being over leveraged?
That's a great question. And you're talking to somebody, and again, as you are choosing a loan officer, you want to find somebody that shares your worldview. Okay. I don't like debt. I have no debt. I have no credit card debt. I have no car debt. My primary residence, I own free and clear. And I bought this property because I'm thinking we may end up retiring there. And because I have zero debt whatsoever, I can pay this off probably in a couple of years. So I'm very conservative. I believe in, and clients do whatever they want to, but I'll share my worldview with them so that they can then do whatever they want to, but at least have, so people don't think the way I do, and that's perfectly fine. But I'm not a big fan of, well, let me say it in a positive way. I'm a big fan of protecting your four walls. Your job is to protect your four walls. I never want to put a client in the position where they could lose their primary residence because they bought an investment property. And people tend to think about debt with rose-colored glasses. They tend to think that there's no risk, there's no downside. There's a lot of risk and downside to debt because you could lose a job or the market could really take a downturn. But one of the even more insidious problems with debt is that you wear it. You think about it in the middle of the night. Okay. When you have no debt whatsoever, it's like that analogy I gave you, walking across the stream with nothing around my legs. Well, now I have this little mortgage that I have in this house that we may retire in. But before that, I can quit my job and just go travel the world because I have no debt, And so, and I don't wake up in the middle of the night thinking, oh my gosh, did I pay the American Express? I don't have to think about that. And so there's a freedom. There's an old saying that the borrower is a slave to the lender. And so my goal as a loan officer, honestly, is to help people get out of debt, is to help people not carry debt. You can't buy a home nowadays without a mortgage. That's the world. But going into it with let's have a strategy to get out of debt as quickly as possible is, so I'm not sure if I answered that question, but I'm not a big believer in pulling money out of a primary to buy an investment property because of the potential risk,
Well, and when people need to look at themselves when they're thinking about that, it's like, how is this investment property going to make you income? And that's the thing. Is it going to be able to pay for itself? Can you handle having two mortgages if there is one on the first one? Or are you only going to be carrying, again, just one single mortgage? You have to make a good financial decision, make your financial health based on that.
There's a certain amount of reading the tea leaves, is this going to pay for itself? Well, you hope it does. And you can get advice and you can look at what the market's been doing, but there's no guarantee. So that's the hard part,
Yeah. What are some common financial mistakes that you see buyers that they make before their closing that can completely derail their loan approval? What are just some of the small? We've all seen some of the funny stories that we have of, but what are some of the common ones that you see?
Most people are pretty good about, not buying the car. I did have one sweet client. It was a struggle getting him to the finish line. He was cleared to close and he bought a car 2 days before closing. And of course I found out about it. We know if you buy a car. So part of this process is we watch over your credit. And so if your credit gets checked, we know about it. We, the lender, know about it. And so I found out about it. It derailed the loan completely. He was crying. He was on the phone alternating between crying and screaming at me. and telling me how frustrated he was. He wasn't frustrated, he was frustrated. Poor guy. So we figured it out. I made him sell his other car. We got him back in line. He was fine. We got the thing closed. But, I think just generally people don't realize that houses cost money. And just it's part of that really first conversation. You've got to have an emergency fund so that problems don't become crises. If you're preparing to buy a home, the smartest thing you can do is start paying off debt and start aggressively saving. Make your saving automatic so you don't have to think about it. Self-control is the only muscle that we have that gets weaker with use. And so you're not going to remember to put money in savings every paycheck. You've got to make it an automatic thing. Start pulling money in. You can save more than you think you can, and you need more than you think you can. $1,000 emergency fund doesn't cut it, So $20,000 sounds about right. 30,000, So just getting your team pulled together and then playing the game of money by the rules is the biggest thing. It's not sexy. It's not exciting, but anybody can be a millionaire if you just play the game of money right.
What are some actionable steps that listeners should take to protect their financial profile during the escrow process?
Don't open credit, obviously. Keep credit card balances, the same or preferably lower. Save as aggressively as possible. And, it just goes into some just good money habits. Every 3 months or so, I'm pretty frugal. I shop a lot at Goodwill, but I still every couple of months, I'll go into my credit card account, and because I pay everything off of my credit card, and I pay off my credit card every couple of days. Is anything on there? I pay it off. So I use my credit card kind of as a conduit, like a drinking straw. I've got a can of Coke. That's my savings account or my checking account. But I don't drink it out of the can. I drink it out of the credit card or the straw. The straw is my credit card. So I use the credit card, but I pay it off every day, every couple of days. Okay. And then that helps me not to spend money that I shouldn't. But even before I get there, I save a huge amount every paycheck. The first thing I do is I like to tithe. So I write my tithe check, but then I throw money into savings. So getting into some really easy habits. If you aren't a commissioned person, if you make just a straight salary, set it up with your IT, or not your IT, but your HR department to have most of your paycheck come into your checking account, but siphon off 10%, 12%, 15%, just automatically to go into savings so you don't even see it. The first month you do it, it's a little bit painful. After that, you forget about it. And keep that savings account in a separate bank, because money's like a puppy and it wants to play with its friends. So in my working capital accounts with Fidelity, I've got a little savings account right off to the side. I need new tires. Perfect. I pull the money out of there. But my real emergency fund is completely separate. Put it in a high yield savings account. The Marcus by Goldman Sachs is a great one. Fidelity, any online bank, because you're not paying for their brick walls and marble floors. You don't have to pay that. You get much more in interest, but keep it totally separate, because then it'll grow and you don't even think about it. And then it's right there for whenever a genuine emergency happens. I told you the story of how I started in this industry, and I really did have 6 kids and I really did have no income. And my ex was, he was going through some things. He never did get a job. And so it really was up to me to figure it out. And I made it through that really horrific time, very expensive time, with an 800 credit score, and kept a roof over our heads. But it was really because I had set my life up properly financially so that I could do that. And so it was not having any debt at all, having an emergency fund. And of course, God's grace and his, he preserved us, so those are some little steps you can, and get with somebody that you can trust, that's going to tell you the truth. Look at your finances and say, hey, if I could wave a magic wand, I would do this. Somebody who's not going to make money off of you for doing it. That's what I do with every one of my clients, so those are some thoughts.
So looking forward, what is the most underutilized loan product that buyers in the Carolinas are currently missing?
There are tons of specialty loan products, but they cost money. So if you want to do sometimes, like I have a dear client, I love her. She's a jeweler. Well, we did a bank statement loan for her, because for a self-employed person, a bank statement loan can be a great option. Sometimes there are some really wonderful loan options for people who maybe have a lot of money in the bank, but very low income. Those are called asset depletion loans. I used to just be able to do them for elderly people. Elderly, it's ridiculous. People over 62. Sorry, everybody out there. That's not elderly at all. But if you're over 62, I can use retirement accounts. But there are other loan options where I can utilize your assets as income. And whereas with people using 401ks, I have to divide that asset amount by 360 for the loan term, essentially. And so it ends up being a somewhat small amount. But for these other asset depletion loans, I just have to take the amount in that account and divide it by 60. And so $300,000 in the bank can become a $5,000 income for you. So that's a great option. And then for our young people just getting started, getting yourself a great real estate agent who can help negotiate some seller concessions that we can use either to pay closing costs, to retain that emergency fund, or my favorite is to do that temporary rate buy down. It helps you to get into a home, and instead of a 6.5% interest rate, maybe it's 5.5% or even 4.5% for the first year. That's a great opportunity to help our young people get into a home and not be strapped financially.
Annika, this has been amazing. You actually answered all of the questions that I was thinking of for all of our buyers, just to kind of get them prepared of what to think about in our area. We have all of your socials. We'll put all of those up, but thank you so much. We know the number one resource is time that we never can get back. So when someone spends their time with me, I don't take it for granted. Thank you so much. I appreciate you.
Truly an honor to speak with just one of our top agents in the area. It's an honor for me. So thank you for the time.
Thanks for joining me on Make Yourself at Home. I hope you found insights and inspiration to help you navigate your real estate journey with confidence. Don't forget to follow, subscribe, and share this show with your friends, because everyone deserves to feel at home. Until next time, stay informed, stay empowered, and keep making moves that matter.